Your $10,000 investment could transform into double, triple, or even blast through the roof with the perfect pick. Today, we're unleashing an epic showdown between two titans, QQQ versus VGT. Which one has the firepower to supercharge your financial future? Buckle up for a high-energy deep dive into their performance, costs, risks, dividends, and more. Let's find the champion that'll take your portfolio to the moon. Let's kick things off with the basics. ETFs, or exchange-traded funds, are like baskets of stocks you can trade like a single share. They're a favorite among investors because they offer diversification without the headache of picking individual stocks. Tech ETFs, in particular, have been stealing the show, fueled by the tech sector's relentless growth. Think artificial intelligence reshaping industries, cloud computing powering businesses, and semiconductors driving everything from your smartphone to electric cars. But with so many tech ETFs out there, why are QQQ and VGT the ones to watch? Meet QQQ, the Invesco QQQ Trust. It tracks the Nasdaq 100 index, home to 100 of the largest non-financial companies listed on the Nasdaq. We're talking household names like Apple, Microsoft, Amazon, and Nvidia, basically the rock stars of tech. Then there's VGT, the Vanguard Information Technology ETF, which tracks a broader tech index, the MSCI US Investable Market Information Technology 2550 Index, with 311 companies. While QQQ mixes in some non-tech players like Costco, VGT is all tech, all the time, covering everything from giants to smaller innovators. Let's peek inside these ETFs. QQQ has 102 holdings, but it's top-heavy. As of May 14th, 2025, its top 10 holdings account for 50.53% of the fund. Microsoft leads at 8.57%, followed by Nvidia at 8.40%, Apple at 8.12%, and Amazon at 5.67%. It's like betting on the biggest players in the game. VGT, on the other hand, has 311 holdings, spreading its bets wider, but don't be fooled. Its top 10 still make up 59.57% of the fund. Apple tops the list at 17.15%, followed by Microsoft at 14.32%, Nvidia at 14.20%, Broadcom at 4.44%, and Salesforce 1.75%. So while VGT offers more variety, it's still heavily weighted toward tech titans. Now, let's talk performance, because numbers don't lie. As of May 14th, 2025, QQQ has a year-to-date return of 1.72%, while VGT is slightly behind at negative 0.88%. Over the past year, QQQ returned 15.35% and VGT 15.43%. Looking at 5 years, QQQ's annualized return is 19.20%, while VGT shines at 20.95%. And over 10 years, QQQ's 17.74% is outpaced by VGT's 20%. Historically, VGT has been the stronger performer, but this year, QQQ's holding its own. How do they stack up against the broader market? The S&P 500, represented by the SPY ETF, has a year-to-date return of negative 0.23% and a one-year return of 12.87%. Both QQQ and VGT have outperformed SPY over the past year, showcasing the tech sector's leadership during periods of economic expansion and innovation. Let's take a step back to 2020. The COVID-19 market crash sent stocks plummeting, but tech companies adapted quickly, fueling a sharp recovery. Both QQQ and VGT saw significant declines in March 2020, but by year-end, they were soaring as remote work and digital transformation took center stage. This resilience underscores the growth potential of tech ETFs even in turbulent times. Performance is key, but costs matter too. QQQ has an expense ratio of 0.20%, meaning you pay $20 a year for every $10,000 invested. VGT is leaner at 0.1% or just $10 per $10,000. That difference might seem small, but over decades, it could mean thousands in savings. Both QQQ and VGT offer dividends, which can be a nice bonus for income-seeking investors. As of May 2025, QQQ has a dividend yield of 0.58%, paying out $2.99 per share annually with quarterly payouts. VGT has a slightly lower yield of 0.52%, paying $3.19 per share annually, also with quarterly payouts. While these yields are modest compared to income-focused ETFs, they add a small income stream alongside potential capital appreciation. Now, let's talk about the catch: risk. Tech ETFs can be a wild ride. In 2022, rising interest rates hammered growth stocks, and both QQQ and VGT took a hit. QQQ's concentration in a few big names means that if Apple or Nvidia stumbles, the fund could wobble. VGT's broader diversification might soften the blow, but it's still tech-heavy. QQQ has volatility of 6.50%, while VGT's is more volatile with 7.68%. The maximum drawdown for QQQ is negative 82.98%, compared to VGT's negative 54.63%, meaning QQQ has seen larger losses in the past. The tech sector is at the forefront of innovation, with trends like AI, cloud computing, and semiconductors driving growth. QQQ, with its focus on large-cap tech companies, includes AI leaders like Nvidia and Microsoft, as well as cloud giants like Amazon. VGT includes these, but also offers exposure to semiconductor manufacturers and other tech subsectors, potentially capturing a wider range of growth opportunities. However, QQQ's heavy concentration means its performance can be swayed by a few companies. If Apple or Microsoft faces challenges, QQQ could feel the impact more than VGT. What do the experts say? Both QQQ and VGT are considered undervalued. QQQ's average price target is $571.21, suggesting a 9.56% upside from its current price. VGT's target is $685.14, implying an 11.10% upside from its latest price. According to some experts, despite concentration risks, VGT performs similarly to QQQ but with lower fees, making it ideal for long-term buy-and-hold investors. So, which ETF should you choose? If you're a fan of tech giants and like QQQ's recent short-term performance, it might be your pick. But if you prefer broader tech exposure, lower fees, and a stronger long-term track record, VGT could be the way to go. Your decision hinges on your investment goals and risk tolerance. In conclusion, both QQQ and VGT offer excellent exposure to the tech sector, but they cater to different preferences. QQQ is ideal for those wanting a concentrated bet on tech giants, while VGT suits investors seeking broader diversification and cost savings. Whichever you choose, remember that past performance doesn't guarantee future results, and diversification is key. Drop your thoughts in the comments. Which ETF are you leaning toward? If this video helped, smash that like button, subscribe Finance FlowChart, and hit the bell icon for more finance insights and ETF comparisons. Happy investing.